Look, if you're managing money today, you are dealing with an absolute avalanche of financial noise. I mean, think about it. You've got social media feeds pushing the latest prediction market craze, breathless headlines about trade wars, these supposed AI wealth hacks. It's exhausting, right? But here's the good news. In today's explainer, we're going to cut right through all that chaos. We're going to find the actual signal hidden in all that noise.
So I want you to ask yourself a pretty hard question right off the bat. Is your financial strategy built on solid ground, or are you just reacting to today's news cycle? Honestly, it's so easy to get swept up in the gamification of investing. So my goal here is to help you step back, log off those endless feeds for a minute, and look at your wealth with the level-headed clarity of a trusted advisor.
Okay, let's dive into this. Here's our roadmap to decoding the madness. We'll start with AI and social media hype, look at the prediction market casino, dive into geopolitics, tariffs, and trade. Then we'll evaluate new investment funds and wrap it all up with an advisor's action checklist. All right, Section 1, AI and social media hype, navigating chatbots and TikTok gurus.
Right now, there is a massive push into AI financial advice. You've got companies like OpenAI testing dedicated finance tools that hook straight into your bank accounts. And yeah, 24/7 on-demand financial planning sounds amazing, but we really need to talk about AI hallucinations. This is when a language model just confidently makes stuff up. We're talking inventing fake companies or phantom earnings reports out of thin air. Even with specialized finance training, these models score around 82.5 out of 100 on hard finance tasks. That leaves a 17.5% gap. And let's be real, in finance, a small math error or a fabricated data point could literally mean you're YOLOing your life savings into entirely the wrong asset.
Now, when you compare the capabilities with the limitations, the contrast is pretty wild. AI is incredibly fast at processing vast amounts of data. It can scan thousands of institutions in the blink of an eye. But the limitations, they're glaring. For one, AI has absolutely zero emotion management. And studies consistently show that investor underperformance is almost always driven by emotion, not bad math. A chatbot is not going to talk you off the ledge during a market panic. Plus, AI isn't a registered fiduciary. It legally doesn't have to put your interests first. That is a massive gap in accountability. So, how should we actually use these tools? Honestly, think of an AI financial advisor kind of like Googling your medical symptoms before you actually see a doctor. It's a starting point, sure, but you have to be careful. Input your data precisely, because even changing how you ask the question changes the output. Scrutinize everything for hallucinations, manually verify the math, and please, whatever you do, never use AI for single stock picks. Language models are basically just predicting the next word. They are not doing deep, fundamental business analysis.
Moving on to Section 2, the prediction market casino. Let's see what happens when we start betting on the news cycle.
You've probably seen platforms like Polymarket or Kalshi, right? They let users bet on binary outcomes, everything from who wins an election to random pop culture drama. And if you believe the social media influencers, you can make a full-time living doing this. Well, a recent independent blockchain analysis of Polymarket found a really sobering truth. 84% of users actually lose money. Only a tiny fraction of the millions playing ever see a meaningful profit. The house, along with a few super sophisticated trading algorithms, almost always wins. Let that number sink in for a second. -8%. According to Gaming Equity Research, that is the median return on investment for retail users on these prediction markets. To put that into perspective for you, the median ROI for traditional, legal U.S. sports betting is a positive 5%. So mathematically speaking, trying to trade news headlines on a prediction market gives you worse odds than just betting on a football game. It's this crazy asymmetric risk where your upside is capped, but you can easily lose 100% of your cash on a single contract. No way. Which brings us to Section 3, geopolitics, tariffs, and trade. Basically, the ultimate macro noise. If there's one thing guaranteed to create noise, it's global macroeconomics. Check out this timeline of recent events. At 8 a.m., the Supreme Court strikes down previously collected tariffs as illegal, wiping out this massive policy tool. But then, by 2 p.m., a brand new temporary 10% tariff is announced under a completely different 1974 Trade Act. And then the very next day, Canada completely pivots and waves a 100% tariff on Chinese EVs to secure a new trade deal. Trying to day trade these headlines? It is pure futility. The policy shifts literally faster than we can even process the news. Now, what's really fascinating is how global conflicts genuinely impact the raw fundamentals of the economy, but they still shouldn't make you panic sell your portfolio. Take the recent conflict involving Iran. The Strait of Hormuz is this massive geographic choke point that facilitates about 20% of all global seaborne crude oil. When threats of closure happen, we see oil jump 30% in a single week, which pushes up inflation and freight costs globally. But here is the so what for your money. Even with very real geopolitical events happening, you just can't build a long-term strategy on short-term conflict headlines. We see traders online screaming to buy defense stocks because missiles are flying. But the data shows that defense stocks often stay completely flat over the year, even during major military actions. Why? Because the broader market prices these global events in instantly. By the time you're reading a headline on your phone, millions of institutional algorithms have already traded on it. Don't let geopolitical noise bait you into ditching your fundamental strategy.
All right, let's pivot to Section 4, Evaluating New Investment Funds. We're looking specifically at sovereign wealth and private markets.
We are constantly seeing shiny new objects pitched to retail investors. A perfect example is the proposed Canada Strong Fund. It's a sovereign wealth fund trying to raise $25 billion for private infrastructure projects. And unusually, they're inviting everyday retail investors like us to join in. Now, on the pro side, you get access to private markets and that feel-good appeal of nation building. But we have to objectively weigh the cons here. Your capital gets locked up, there's massive execution risk with cost overruns, and of course, there's the ever-present danger of political motives overriding actual profitable investment logic.
So, the absolutely crucial thing to understand here is liquidity. Buying into a private infrastructure fund is not like buying a stock or an ETF where you can just hit sell and get your cash in seconds. It is way more like buying a physical house. These massive infrastructure projects can take a decade just to turn a profit. And hey, even if a government guarantees the retail capital so it feels safe, it often creates a dangerous home country bias. You're tying your investment portfolio directly to the exact same local economy that already dictates your job and your home's value. Diversification is key.
And actually, just a quick aside on political noise while we're talking about sovereign wealth. We frequently see headlines amplifying fringe political movements, like, say, Alberta separatism in Canada, which objectively only has a minority of actual support. Look, whether it's domestic separatism or foreign policy theatrics, this kind of amplified political anxiety is engineered to generate clicks. It's not designed to generate wealth. It should be entirely ignored when you are building the core long-term allocations of your portfolio.
Okay, let's move to our final section and see how all of this builds into an actionable, level-headed framework. Section 5, the Advisor's Action Checklist, focusing on the fundamentals. All right, here is your concrete action plan to bulletproof yourself from all that noise. First, secure the foundation. Maintain a 3 to 6 month cash emergency fund. Second, diversify globally so you aren't completely exposed to local tariff wars or single-country infrastructure risks. Third, by all means, use AI. Use it to brainstorm, use it to organize your budget, but never rely on it as a legal fiduciary. And finally, please stop trying to day trade the news on prediction markets or social media tips. It's literally a mathematical losing game. I want to reframe a trope we hear constantly from online finance gurus, because there is a core truth buried under all that hype, and it's this: the wealthy deploy cash for growth. They let their money work harder than they do by converting it into productive assets. Building true wealth isn't about gambling on whether a pop star is getting married or day trading some oil pipeline headline. It's about patiently owning productive assets, like broadly diversified businesses and stocks that actually compound in value over decades, completely regardless of whatever is on the news today. Which brings us to our final question for you. When you really look at your portfolio, are you investing for entertainment or are you investing for freedom? The signal is in the structure, the noise is in the feed. So here's your takeaway. Take an hour this week to just log off, review your actual asset allocation, and make sure your financial house is built on solid ground. Thank you so much for joining me on this explainer. Keep learning, stay focused, and we'll see you next time.